The current live trading price for New Fortress Energy Inc. stands at 1.44 USD, showing a massive intraday surge of plus 0.21, which translates to a volatility-injecting 17.62% gain as of this very moment on Monday, December 1, 2025. While the broader markets might be drifting or reacting to their own macroeconomic signals, NFE is trading with the kind of violent, idiosyncratic momentum that demands immediate attention. When you see a stock with a market capitalization that has been battered down to these levels suddenly rip higher by nearly 20% in a single session, your first instinct might be to dismiss it as a dead cat bounce or a short squeeze in a dying asset. That is the expectation, that New Fortress Energy is a distressed asset gasping for air before the final plunge. The reality, however, is significantly more complex and far more interesting. We are not just watching a random fluctuation, we are watching a company potentially pull itself back from the brink of a complete capital structure collapse due to a massive, fundamental development that the market had largely written off as impossible. The gap between the expectation of bankruptcy and the reality of a newly approved multi-billion-dollar contract is where the opportunity and the extreme risk currently lives. To understand why this price action is happening right now, you have to look beyond the simple percentage gain. The headline driving this move is the tentative approval from Puerto Rico regulators for a massive LNG supply deal, valued at approximately $3.2 billion. This isn't just a small contract win, this is a lifeline that validates the company's core business model at a time when creditors are circling. The market expected New Fortress to slowly suffocate under its debt load, with the Puerto Rico deal falling apart due to regulatory scrutiny. The reality is that the Financial Oversight and Management Board for Puerto Rico has given conditional approval, effectively securing a 7-year revenue stream that could stabilize the ship. This news has triggered a violent repricing because it forces short sellers, who were betting on a zero-value outcome, to cover their positions aggressively while simultaneously attracting deep-value investors who see a company trading at distressed levels despite securing billions in future revenue. It's a classic disconnect between the going-to-zero narrative and the business-as-usual operational reality. However, we need to have a serious coffee shop-style conversation about the financial health of this company because the 17% gain today does not erase the massive red flags on the balance sheet. This is not like buying Apple stock or holding steady Nvidia stock, where the balance sheets are fortresses of cash. New Fortress Energy is in a race against time. The company is currently operating under a forbearance agreement with its creditors that expires very soon, specifically around mid-December. This means that while they have secured a massive long-term contract, they still have to survive the short-term liquidity crunch. The stock is trading under $2 for a reason. They have significant debt maturities coming up, and they have been burning cash to build out infrastructure in places like Brazil and Nicaragua. The tension here is palpable. Can they use this $3.2 billion contract win to negotiate a longer-term debt restructuring before the clock runs out? If they can, the stock at $1.44 is a steal. If they can't, and the creditors decide to force a liquidation or a harsh restructuring that wipes out equity, today's gains will evaporate instantly. This is binary investing at its most extreme. Let's talk about the business itself because it is actually quite fascinating and distinct from a standard energy play. New Fortress Energy is essentially an integrated gas-to-power infrastructure company. They don't just drill for gas. They build the logistics to move liquefied natural gas to places that desperately need it, and often they build the power plants that burn that gas to generate electricity. Their business model is about solving energy poverty and shortages in developing markets or island nations like Puerto Rico and Jamaica. They build floating storage and regasification units, basically giant ships that turn liquid gas back into vapor, and park them off the coast of countries that lack energy infrastructure. It is a capital-intensive business, which is why they have so much debt, but when it works, it prints cash. This is why the Puerto Rico deal is so critical. It proves their model works and that governments need what they are selling. It is not just a commodity trade, it is an infrastructure utility play. Now, consider the broader investment landscape. If you are managing your own money, perhaps using tools like Schwab Intelligent Portfolios or a Fidelity trading platform, you are likely conditioned to look for safety and steady compounders. You might be looking at Fidelity mutual funds or Fidelity ETFs that track the S&P 500. New Fortress Energy is the antithesis of that. This is a stock for the part of your portfolio designated for high risk, high reward. It is more akin to the early chaotic days of Tesla stock, where the operational ambition was huge, but the cash flow was terrifyingly tight. The difference here is that NFE is dealing with sovereign clients and complex regulatory environments. If you are using a Robinhood app or doing some self-investing on SoFi Invest, you might see this ticker trending and feel the urge to jump in. But you have to understand that this is not a passive investment. This requires daily monitoring. You are betting on the management team's ability to navigate a debt minefield while simultaneously executing on massive construction projects. The recent price action also tells us a lot about market psychology. When a stock falls below $2, it often gets abandoned by institutional investors. Big funds that operate under strict mandates often can't hold stocks trading at these levels. This leaves the playing field open for hedge funds, algorithmic traders, and retail investors who are willing to take on the risk. The volume we are seeing today suggests that some bigger players might be stepping back in, perhaps sniffing out a turnaround. If you look at the activity on interactive brokers trading platforms, you'll likely see a massive spike in options volume as traders bet on the volatility continuing through the December 15th forbearance deadline. This is a battleground stock. The shorts are convinced the equity is worthless, the longs are convinced the assets are worth billions more than the market cap implies. One of the most critical aspects of the reality we need to discuss is the specific terms of the debt restructuring. The company has been negotiating with note holders to extend maturities and reduce immediate cash interest payments. The forbearance agreement was a temporary band-aid, buying them a few weeks of time. The Puerto Rico deal gives them a massive bargaining chip. Creditors are far less likely to push a company into bankruptcy if that company just signed a $3.2 billion contract that guarantees future cash flow. They want to get paid, and destroying the equity might destroy the operational ability to fulfill that contract. So, in a weird way, the interests of the bondholders and the shareholders are realigning today. That is the hidden catalyst fueling this rally. It's not just about revenue, it's about leverage in the boardroom negotiations with lenders. Let's pause for a second and get a pulse on the room. Comment below how many shares of New Fortress Energy you currently hold, or if you are looking at this price action from the sidelines, terrified to touch it. It is always interesting to see where the retail sentiment actually sits when a stock is moving this violently. Moving back to the analysis, we have to look at the macro picture for LNG. The global appetite for natural gas is not slowing down. Despite the push for renewables, gas remains the critical transition fuel, especially for island economies that rely on dirty diesel or heavy fuel oil for power. New Fortress Energy replaces that dirty fuel with cleaner natural gas. In Puerto Rico, their presence is vital for the stability of the electrical grid. If New Fortress stops supplying gas, the lights go out. That gives them a level of political protection that a standard company doesn't have. They are essential infrastructure. This essential nature is what provides the floor for the stock even when the financials look grim. The government of Puerto Rico, and by extension the U.S. Oversight Board, has a vested interest in keeping NFE operational. However, the risks are not just financial, they are operational. They have projects in Brazil that have faced delays and cost overruns. Building energy infrastructure in emerging markets is incredibly difficult. You have permitting issues, local opposition, and logistical nightmares. NFE has been aggressive, perhaps too aggressive, in expanding its footprint before securing its balance sheet. This expansion strategy is what got them into this debt mess in the first place. They borrowed heavily to build fast, banking on the idea that the cash flow would catch up. It hasn't caught up fast enough. That is the core tension. The expectation was that their growth was sustainable. The reality is that they overextended and are now paying the price. But again, if they survive this liquidity crunch, they own valuable assets that are almost impossible to replicate. For those of you who use online investing sites like SoFi or manage an interactive broker's account, you know that debt covenants are often the silent killers of equity. NFE has had to get waivers from lenders just to keep operating. This means the lenders are effectively in control. They can dictate terms, demand higher interest rates, or force asset sales. We have already seen NFE looking to sell assets to raise cash. This is a double-edged sword. Selling assets pays down debt, but it also reduces future earnings power. It's a shrinking of the business to save the business. Investors need to watch closely to see if they sell their crown jewel assets or if they can get by selling non-core pieces of the portfolio. Let's compare this situation to other distress stories. Often when a company hits this level of distress, the equity is wiped out even if the company survives.